Hello, I'm John Taylor of Stanton Park Advisors. We're a middle market investment banking firm, and our professionals have worked with more than 100 market-leading businesses all over the country, and we've raised more than $2 billion in capital for many different businesses over a 15-year period. And what we've put together here is a streamlined leverage buyout model to help business owners understand how private equity firms value businesses, and also how a business owner might value his or her own business or a business that he or she might want to buy. So this is a very simple tool, and it's something that it's sort of the bread and butter of the private equity industry. It's how private equity firms analyze businesses, how they can determine what kind of returns they can expect to make for their investors, assuming a certain set of financial projections. So this captures a lot of important information to help private equity firms or a financial investor evaluate a business for its valuation. And I'm just going to spend the next 10 minutes going through the various inputs and outputs for this model, and to help you understand how it works so that you can use it yourself. So here in the top portion of the model is where you enter key inputs and assumptions. And I should say, just to start off as well, you want to make sure that you set the calculation iteration so that it will Excel will resolve circular errors in the model. So the way to do that is you go to Excel options, click on formulas, and you enable iterative calculation. So click OK. You also want to make sure that Excel is doing automatic calculation. And that's because you have circularity in this model, because with integrated financial statements, we build out an income statement, a cash flow statement, and a balance sheet. And what you have happening is your balance sheet calculates your cash flow statement items, and your cash flow calculates cash, which is a balance sheet item. So you have basically your cash flow statement helping to calculate your balance sheet, and vice versa. So that's where you get circularity in the model. So basically, to start off, you enter the company name here. You enter the fiscal year end for the current year. So in this case, it's December 31st, 2014, because this company, this hypothetical business we're assuming is on the calendar year. Date of transaction analysis. Date of transaction offer. So this is the date, 12/31/2014 is when we're assuming this transaction is going to close. This company is going to be sold to a new owner, and so 2015 is going to be the first full year out of the box, so to speak, for new ownership team going forward. So 2014 is your pro forma year, because we're estimating income statement and balance sheet items for 2014, because it's not yet complete, but we're going to build projections for those. These other sections, I'll get into them later, so let's start off first by going down to the income statement and filling in the various items here. So starting off with sales, this business does $15 million in sales with cost of goods sold of $9 million, so gross profit of $6 million last year in 2013 for a gross margin of 40%. And what we're going to, in here, we're just for simplicity, we're just going to assume that gross margin is going to stay the same at 40% going forward for our projection period, which is 2015 to 2020. And then sales growth, we're just making 15% every year. Of course, you can change this if your business is just growing 5% a year, you could dial it down, or you could change this. If the growth rate is higher and then goes lower in the future, you can adjust this model to do that. So anyway, it's a pretty simple income statement here we're using, very streamlined. So SG&A expense $4.6 million. We calculate our operating profit, and then depreciation is $400,000. So $1.8 million in EBITDA. So forth till we calculate income. So as you can see, the blue items are inputs, black are formulas, which do automatic calculations for you. You can override the automatic calculations if you like. This was just set up to make it easy to use. So you're just entering 1 year of income statement items and trying to project a very simple income statement going forward. I should point out, so we're assuming that the EBITDA margin is 12%, and we're just making it 12% going forward just for sake of simplicity. A lot of companies, you might assume that your EBITDA margin would increase because as the company grows, you get operating leverage, and so more overhead is absorbed. You get greater economies of scale and greater profitability. But we're just going to say, for simplicity, it's 12% going forward. And then marginal tax rate, 38%. So let's see, going down here, the cash flow statement is calculated automatically here because we're just entering 1 year of balance sheet. So everything else is calculated for you. So you enter cash, accounts receivable, inventory, prepaids. That gets you your assets, net property, plant, and equipment. And of course, that's projected forward by adding capital expenditure and then subtracting depreciation to get your net PP&E. And in this case, we just use a simplifying assumption that depreciation is going to equal capital expenditure. That may not be the case in your business or most businesses, because especially in a high growth business, you tend to have more capital expenditure than depreciation in the company if it's an asset intensive type of business. Let's see, going down here, we enter accounts payable and accrued expenses. We also have our debt items. So anyway, you fill in 1 year for the balance sheet, and you want to make sure the balance sheet balances. Otherwise, you're not going to have return calculations that make sense. But this is a pretty simple balance sheet. This is the financial assumptions page where we calculated capital expenditure. So capital expenditure is 2.7% of sales, so that's $400,000. We just projected 2.7% of sales is what CapEx is going to remain going forward. Accounts receivable, we have 36.5 days of accounts receivable, 50.7 days of inventory, and 2.4 days of prepaid expenses, and we just assume those same balance sheet ratios going forward. We're not changing them. Accounts payable 20.3 days, and accrued expenses 8.1. So as you can see, we're just basing all these working capital ratios based off the 2013 balance sheet for sake of simplicity. Down below here, these two pages are just used to calculate the returns. You don't need to make any changes to them at all. They're just calculating the internal rates of return for, as you can see, for the equity sponsor and for the mezzanine holders at various EBITDA multiple exits and years. And those returns end up here on this in this section in the outputs. So basically, so this business, we're assuming an $11.2 million sources, which is technically the purchase price of the business, and that gets us. So if we assume if we sell the business for 6 times EBITDA in 2019, that gets us to a 34.5% rate of return for the equity investor. If it sells for 5 times, it's 29.7% internal rate of return. If it sells for 7 times EBITDA in 2019, it's 38.6. So you have this EBITDA sensitivity so you can kind of see what the range of return scenarios could be. Now let's turn to the sources of funds. So here we have new equity sponsor. This is the amount of equity contribution the private equity firm is going to make. So it's $4 million, and they're acquiring 80% of the business because the existing ownership team is going to roll over part of their equity stake for 20%, which most private equity firms require existing ownership or management to roll over part of their ownership in the business because they want to partner with the management team going forward, so they want them to have an equity stake or skin in the game, so to speak. They're also giving the management team 10% options in the business, which is going to dilute the equity sponsor's ownership in the future. And then the mezzanine investor is getting 5% warrants so that basically their returns are going to be higher than their 10% coupon here. Because typically a mezzanine investor is going to want kind of mid to high teens type returns. So basically here, so 2019, 34.5% rate of return. Now, if we wanted to say, look, this private equity or this investor was willing to accept a 30% rate of return to invest in this business, what we could do is just increase the equity contribution a little bit here. Say it's $5 million, and then see their rate of return goes down because they put more equity in and they paid a higher purchase price. But so that's going to push down their returns in the out years. So that's basically how that works. For the debt contribution, as you can see, it's about 50% equity sources here, 40% plus 10%, and then 50% if you sum up all these debt contributions. So it's about half a turn of EBITDA for mezzanine warrants, 1 turn of EBITDA for new senior notes, and then 1.5 turns of EBITDA for the new revolving credit facility. And these are the various interest rates paid for those tranches of debt. And as you can see, so if we wanted to say that the mezzanine holder would accept a lower rate of return, we could say 3% warrants here. So that would get them to about a 19% rate of return in 2019. So basically that's how it works. Again, here's the exit EBITDA multiple, which you could make this 5, and that's going to dial back our returns a little bit. We're just saying it's 6 times here because we're assuming this business is being purchased for 6 times EBITDA, and then it's being sold at 6 times EBITDA. So that's a conservative assumption in the sense that you're not assuming any EBITDA multiple expansion over the course of ownership in this business. It's not going to increase, which would dramatically increase the returns. So anyway, that's this model, just kind of in a nutshell. Feel free to send me an email if you have additional questions or would like a consultation for your business. My email up here at the top again is jon@stantonparkllc.com. Hope you enjoyed this presentation and using this model, and look forward to speaking with you at some point. Thank you very much. Bye-bye.